On this week's episode of mlenow.ca, we're going to be talking about mortgage insurance. What is it? Why do you need it? Where did it come from? We're going to be talking about the latest changes that CMHC let us know about this week in terms of their program and the effect that that's going to have on Canadians. And we're also going to talk about a real-life example of a client who didn't have great credit that was able to get pretty good terms on his mortgage renewal. So stay tuned. My name is Gallagher. I'm the founder of mlenow.ca. I'm a finance guy that's been helping people and businesses get mortgages and loans for the past 18 years, work with private investors and manage money for them in debt transactions as well. We put together this podcast and this video cast for all things finance, including debt, because we think that if we're able to tell you a little bit more about what happens in the marketplace as it relates to your finances, that you're going to be in a position to make better decisions. And if you make better decisions, that can mean pretty big changes for your financial future. And so in some little way, we hope that we're helping you do that. And some of those changes can be with some of the things you learn here. You can make better investments and new opportunities. You might be in a position to give more to the community around you because of your newfound wealth, hopefully, or just something simple like saving money on the financial transactions that you're considering. So we'd encourage you to visit mlenow.ca. If you do need a mortgage or loan, you're going to find lots of great, helpful information there. It's a unique platform that we built off of 18 years worth of experience, and it's still pretty young, but getting a lot of traction, and we hope that it's able to help you out. And if you have any questions, we'd encourage you to follow us on Twitter. We're mlenow.canada, and you can like us on Facebook, and we are posting our content there so that you can learn about kind of all things finance. And we try to do it in a way that you'd understand. We don't want to make it complicated. We think that the market is complicated enough as it is. And so in these episodes, we really just try to focus on stripping it down and making things simple, and ultimately because we want to help you do more. At the beginning of every episode, we usually start with answering a couple of questions, and the purpose of answering these questions is again to give you information that you may not understand, or things that you might not be getting answers to somewhere else. So let's go with the first question. What is mortgage insurance? I'll give you the stiff definition of it, and then I'll kind of give you the practical definition of it afterwards. But it's insurance that's required by individuals who are purchasing homes who have less than 20% to use as a down payment. And it's ultimately insurance that protects the bank against you not making your payments. And I know some of you might be thinking, oh, well, I'm always going to make my payments. I'm getting this mortgage because I fully expect to get my payments. And that's great, but the reality is that people do default on their mortgages, and because mortgages are such an important cornerstone of the economy, mortgage insurance helps to make sure that more people have access to mortgages, and ultimately that banks are protected in the event that someone who doesn't have enough of a down payment based on the bank standard can still get home ownership is still something that would be accessible to them. So much like an insurance policy, there's a premium. That premium is added to your mortgage amount, and so you might find that if you're purchasing a home and your mortgage is a couple $100,000, that you're going to have this extra amount added to it, which is ultimately insurance that if in the event you stop making payments, the bank is able to make sure that they don't take a loss on your mortgage. A quick little side note here, mortgage insurance is not the same as mortgage life insurance. And so a lot of people confuse the two. Mortgage life insurance would be your mortgage being paid off in the event of your death. Mortgage insurance, as we're talking about it today, is to protect the lender against you not making any payments. So the backstory, thanks to Wikipedia and my own interactions with various people in the marketplace, but basically where mortgage insurance came from was just at the tail end of the Second World War, the government was concerned about all of the soldiers that were going to be returning back to Canada, and that there would be a shortage of housing for them and their new families. And so there was a Crown corporation, or a government corporation, that was created to start putting up communities in various parts of Canada. But at the same time, these new homeowners didn't have enough of a down payment to be able to purchase these homes. And so because of that, the banks, in essence, said, look, we can't just lend money to people that don't have enough of a down payment. Normally, it was common practice that someone would save up for half of the price of their home, then they would be able to go to the bank and get the other half. And that was kind of the standard. But when these soldiers were returning back from World War II, they obviously didn't have those sorts of financial resources, and the bank said, well, we don't know how to fix this problem because we can't take on the additional risk of lending people more money than what we're prepared to lose. And in the event that we lend them the money and we lose it, that could have bigger financial implications across the market. So the government said, well, I'll tell you what, we'll provide insurance. So if somebody meets a certain criteria, banks, go ahead and lend them the money. We'll charge them an insurance premium. And in the event that we've collected enough of these premiums from all of these homeowners, that in the event that any of them default, there would be enough money in the pool to make sure that you, the bank, don't take any losses. And so that's kind of where mortgage insurance came from. It was meant to help give more people access to home ownership who didn't have enough money to meet what was then the bank's requirement for how much down payment you needed. And again, it was normal that if you're going to buy a property, you would save up half of the purchase price, the bank would lend you the other half. But because these returning soldiers in the marketplace in general, housing prices has started to go up because of supply and demand, and people just found, look, I don't have half the purchase price. I don't have 50% to put down. I have 5% or I have 10%. But the banks weren't prepared to lend to those particular individuals, so the government stepped in with an insurance program called CMHC, or it evolved into CMHC, and it was basically designed to protect the banks in the event that someone who had less than a certain amount of down payment, if they didn't make their payments, that the bank would get a payout from the policy. So that's mortgage insurance, and I would encourage you to check it out. The story is actually quite interesting of how it evolved in Canada. There are similar stories of what happened in the United States, but for us Canadians, what we're focused on is how it happened here. And so check it out on Wikipedia. We'll post the link on our Twitter feed in case you are interested. And anyway, so that's what mortgage insurance is. Moving right along to question number 2. Are commercial mortgages and business loans insured? Well, the short answer is no. There is no mortgage insurance for commercial mortgages. There is no business loan insurance for business loans. And this is because the banks have a different criteria for how they put this money into the marketplace. So if you've ever applied for a commercial mortgage or a business loan, you'll find that the process that you've been taken through, first of all, probably took a bit longer than it might have for your house. But the banks they limit their risk on how much they're prepared to lose by creating criteria. So for example, if you are purchasing a commercial building, it's standard practice that the banks will lend you 65% of whatever that building is worth, because they're fairly confident that if you're a borrower who's going to be putting up the other 35% in the form of a down payment, that you're very, very motivated to make sure that the mortgage or the business loan is paid as agreed. And in the event that you end up not making your payments, that 35% is enough for the bank to be able to liquidate whatever it is they need to liquidate from your business or from the property to recover their money. And as well, because mortgage insurance was designed for home ownership, there is no such equivalent in the business community, because by my opinion is, based on the nature of what business is, commercial transactions, that there's risk, there's reward. Banks charge higher interest rates to compensate themselves for that risk. They charge fees, which are payable by commercial mortgage borrowers and business loan borrowers. And so the entire credit criteria and how money moves into the marketplace for commercial mortgages and business loans is quite different than how it works for residential mortgages. And so there is no insurance for commercial mortgages and business loans that protects the lender against default. the way lenders protect themselves is they make it hard to get the money so that you've got to fit really good criteria, and then they charge you higher rates of interest compared to residential mortgages, and they also charge you fees. I was talking with a good friend of mine who's also a client, and his mortgage had come up for renewal. It was a year ago, give or take, and when we were able to get him the mortgage, didn't have really great credit, was part of the flooding that had happened in southern Alberta here last year, and had bumped into some troubles. But we were able to get him a mortgage. We were able to get him a mortgage with what we would refer to as a mid-market lender. And so for those of you who don't know what a mid-market lender is, there are your traditional banks who are the most affordable money in the marketplace. They're the prime plus or the prime minus money that you hear about all of the time. And on the other side of the spectrum, there are private lenders who we just sort of categorize as double-digit plus money. But then there's a group in the middle that we refer to as mid-market lenders. And so this particular client that we had been able to help, we were able to get him a pretty good mortgage. The interest rate was about maybe 5% or somewhere around there, based on his credit. And it wasn't that he had bad credit. It turns out he actually just didn't really have any credit, and the credit that he did have was old and it didn't report very well on his bureau. So this was sort of the only place we could go. And then his mortgage renewal came up, and then we went to try and work to get him a better deal. And we were not able to do that, mostly because there aren't a lot of mid-market lenders that are providing mortgages today for properties that were located within any of the flooding areas or anywhere close. So, unbeknownst to me, my friend calls the bank and says, you know, guys, I've got my renewal notice here, but the interest rate has gone up, and you're telling me it's because of the credit that I have. You've checked my credit, and therefore you've increased my interest rate. But you know what? I went back and looked. Nothing on my credit has changed since a year ago when you guys agreed to do the deal. And so I think that if you were prepared to give me, you know, this rate at this time a year ago, I don't know why you're charging me more a year later when really nothing in my life has changed. In fact, I've been at my job longer. We've saved up more money. You'll notice that my net worth is a little bit higher. And so, guys, you know, you sure there's nothing you can do for me? And my friend had called me while he was doing this, and he was, you know, hoping that he could get a better interest rate. And anyway, about 15 minutes later, the banker had called him back and said, you know what, you're right, we did take a look into it, and as it turns out, not only are we going to just knock the rate back to what it was a year ago, we're actually going to make it lower than that. So you're going to be able to save a little bit of money. So for those of you that have a mortgage renewal coming up, obviously we would encourage you to shop the market, make sure that you know what the best rates are. Make sure you understand what's available to you. But for those of you that might have blemished credit or credit that's not perfect, and you get a renewal notice, it doesn't hurt to pick the phone up before you sign that sheet of paper and send it back to the bank. It doesn't hurt to pick the phone up and say, hey guys, are you sure this is the best that you can do for me? Because if I look at my credit situation, not a lot has changed since you guys gave me the mortgage. And so that might end up saving you a little bit of money. And if not, hey, at least you gave it a try, and I guess you never know unless you do try. So the big news this week was, well, big news. I guess that's relative if you're not in the finance business like we are. But CMHC, which is the Canadian Mortgage and Housing Corp, which provides mortgage insurance to millions of Canadians, they discontinued insurance today for second homes, and they changed the criteria for self-employed borrowers. So just to make sure we say this properly, a second home would be a vacation property, for example. So say that you wanted to buy a cottage you know, on a lake, a summer place, but you didn't have 35% to put down. CMHC had what was called a second home mortgage that you could put down less than 35% and still be able to purchase that property. They've now done away with that program, so as of May the 1st, no luck if you're looking to buy a second home and you don't have the down payment. You won't be able to go to CMHC to get them to insure the mortgage that the bank hopefully is going to give to you. But then the second one, which is a little bit more probably has more of an effect on the market, which would be self-employed individuals. CMHC, or back in a few years ago, it used to be that if you were self-employed, you could kind of say I'm a self-employed electrician and I make $90,000 a year. And for the most part, the insurance companies, because CMHC is not the only one, but the insurance companies providing mortgage insurance would say, is it reasonable that an electrician could make $90,000 a year? And if the answer was yes, then they would go ahead and simply approve the deal as if that particular individual had made that amount of money. And then the market changed during the downturn, and insurance companies went, well, wait a minute, we don't want to have to kind of make an arbitrary decision like that. We want to see some kind of evidence that you make this much money. So we'd like to see a business license. We'd like to maybe see your articles of incorporation to prove that you're self-employed. And so there's a little bit of paperwork that was involved in order to do it. And now what the CMHC in particular has taken the step, and I'm sure the other insurance companies will follow suit shortly, but now they've said they want third-party verification. So they actually want to prove that if you're self-employed as an electrician and you say you make $90,000 a year, you now have to prove that you make that $90,000 a year. And so you wouldn't think that's troubling, except that for most self-employed individuals, assuming that they're profitable and they're making money, the way they take their money out of the corporation is usually through a dividend. And that's because on the advice of their accountant, a lot of times an accounting firm or an accountant who's doing the financial records or the bookkeeping for someone who owns their own business would say, look, pay yourself a dividend. That way you don't have to have a deduction for CPP and EI and go through your payroll system. The dividend is a much better way to do it. The problem with that is that dividends are not recognized by banks as actual income. There's a bit of work involved in proving to a bank that if you've consistently received this amount of a dividend, that it's sustainable into the future, and it can be evidenced by the history. So now self-employed individuals are going to have to start figuring out how to prove to the bank that they make the money they say they're going to make, and the bank wants the insurance companies rather, want third-party verification. So what does this mean? This means that if you're self-employed and you're going to have less than 35% or rather less than 20% to put down on a property, that you're now going to have to make sure you've got all the evidence available to you that you make the amount of money you say you make. And so while probably not going to have a huge effect on the marketplace, there's certainly a percentage of people that are self-employed that were able to purchase a home under this type of a program, and now they're just going to have to jump through some more hoops to do it. So my own opinion on this is, first of all, I think that these changes are all good. I'm a supporter of government getting involved. If I look at the Business Development Bank of Canada, for example, and the way during the downturn they were able to make sure that money was still moving in the marketplace when other banks had just simply decided they weren't going to lend, I think that there's a role for government. I think there's a place for government. In insurance, for me, the thing I always struggle with is that CMHC is so huge. They're just this massive, massive crown corporation, a company owned by the government. They make money. They're helping individuals get into homes. But there's other insurance companies in the private sector that could be picking up the slack, but they're just not. And I don't know if that's because they're not innovative enough. I don't know if they're not creative enough. I know that there's some subtle differences between the insurance offered by CMHC and the insurance offered by these other companies. But nonetheless, I think that these changes are good. I think CMHC does need to pull back out of the marketplace and allow private insurers to come ahead of them. But if private insurers aren't going to get ahead, if they're not going to be innovative, and if they're not going to try and be creative in how to help people purchase homes, then CMHC kind of by default continues to fill the difference. So I think these changes are good. I don't think the changes affect a huge percentage of the market. I think it's contained to a very small group of people that were using insurance for a cottage, or maybe helping a child purchase a home when the parents themselves had a mortgage, or people who were self-employed. So I don't think it's going to send ripples through the industry, but hopefully it's the continuation of other changes that are going to see CMHC continue to pull out of the market and force private enterprise to figure out how to solve the difference and ultimately help Canadians continue to purchase homes. So that's our episode today. Hopefully you've learned a little bit about mortgage insurance. Hopefully you've gotten some tips on, if you're going to have a mortgage renewal coming up, how it's pretty easy to pick the phone up and talk to the bank that's offering you the renewal to see if you can get better terms. And we look forward to seeing you on the next episode. In the meantime, I encourage you to visit mlenow.ca. That stands for Making Life Easier Now.ca. And so if you're looking for a mortgage or a loan under $10 million for a commercial mortgage, a business loan, or maybe you're purchasing a residential property, that's the website that you need to go to see how much you can afford, what the payments are going to be, what the paperwork required is. And man, we've just made it so simple that in less than 3 clicks you can figure out if you're going to get approved or not. And then you can submit your request to us. We'll help place it at the bank for you. And if you don't want to use us, no problem. There's an option there where you can send it directly to the bank, and they're going to be able to pick up your application and get in touch with you. So thanks for watching, and we'll see you on the next episode.